Welcome to today's video on avoiding the 1% fee trap as you approach or enter retirement. You've spent decades accumulating wealth, paid off debt, and now the mission changes from growing assets to creating a reliable, tax-smart income. In this episode, we'll explore why the traditional accumulation playbook fails during retirement, how to evaluate advisors and fee models, and what to prioritize for tax-efficient withdrawals. We'll also show how a one-time plan with a fee-only fiduciary can sometimes beat an ongoing 1% assets under management service, especially for simple, debt-free situations. To keep things practical, we'll use diagrams, a quick cost comparison table, and a step-by-step checklist. First, let's outline today's roadmap. Here is our game plan. We begin by contrasting common 1% assets under management fees with the fiduciary standard. Next, we break down why accumulation strategies often fail during decumulation. We then dive into asset location, tax minimization with Roth conversions, and setting an optimal withdrawal sequence. After that, we move to a practical DIY checklist and a cost comparison table. We will reinforce the ideas with visual diagrams and quick quizzes to test comprehension. Finally, we wrap with key takeaways and a concise summary. Now, before we go deeper, a brief but important disclaimer. This video is for educational purposes only and is not individualized financial, tax, or legal advice. Everyone's situation is unique, and laws and regulations change. Before implementing any strategy, consult a qualified, fee-only fiduciary advisor and a licensed tax professional, or CPA. All examples are illustrative and may not account for your specific circumstances, portfolio composition, or tax brackets. With that foundation in place, let's move into the 1% fee trap versus the fiduciary standard. At many large brokerages, assets under management fees of around 1% are common. On a $2 million portfolio, that is roughly $20,000 per year, and the fee rises as markets grow. In contrast, a fee-only fiduciary must put your interests first and often offers transparent hourly, flat fee, or project-based pricing that can better match retirees' needs. Especially in retirement, where the emphasis is on distribution planning rather than high-frequency trading or product sales, you may only need a concentrated planning engagement rather than open-ended management. Be cautious of sales-driven models whose incentives may not align with your long-term goals. Next, let's examine why the old accumulation playbook stops working when you retire. On the left, the 1% assets under management model charges a recurring fee that scales with account size, which can add up to a large dollar amount annually. This approach may incentivize selling ongoing management even when the client primarily needs distribution planning. On the right, fee-only fiduciaries tend to focus on client-first planning and may offer flat fee or hourly services. This allows clients to pay for specific guidance at specific times, without committing to perpetual management fees. With the trade-offs clear, let's understand why the accumulation mindset often breaks in retirement. During accumulation, the formula is straightforward: save, invest, and compound. In retirement, the objective shifts to generating income while minimizing taxes across different account types. The biggest drag often becomes taxation, not market returns. Therefore, you need clarity on monthly cash needs, your state tax landscape, and recurring expenses. Additionally, if you hold substantial idle cash while paying high advisory fees, you could be reducing long-term efficiency. With this context, let's tackle the first critical lever: asset location. This flowchart illustrates a common withdrawal order. It starts at retirement and points to maintaining a 6 to 12-month cash reserve for immediate needs. Next, it shows drawing from taxable accounts, with a decision node to check if you can realize long-term capital gains within the 0% bracket. Concurrently, it branches to evaluate partial Roth conversions from your traditional IRA before required minimum distributions begin, ensuring you convert only up to the desired marginal bracket threshold. Later, when additional income is needed beyond taxable accounts, you draw from the traditional IRA. Finally, Roth assets are generally preserved for late retirement or legacy due to their tax-free growth. Next, let's zoom in on asset location itself using a second diagram. This pie chart gives an illustrative snapshot of how assets might be distributed across tax buckets. Tax-deferred accounts like traditional IRAs and 401ks often occupy a large share, followed by taxable brokerage accounts. then Roth accounts, and a smaller cash allocation. The exact mix will vary by household. The purpose is to remind you that each bucket has different tax rules, and that placing the right assets in the right buckets can reduce ongoing drag. With the big picture established, let's translate asset location into practical guidelines. Asset location aligns investment types with account tax characteristics. Typically, interest-heavy holdings, such as bond funds and high-yield instruments, are more tax-efficient in tax-deferred accounts because interest is taxed at ordinary income rates. Taxable accounts are better suited to tax-efficient index equity funds and qualified dividends, which may receive preferential long-term capital gains treatment. High-turnover active funds in taxable accounts can create unnecessary annual taxes. Mixed asset funds in taxable can also be problematic because you lose precise control over the timing and character of distributions. With location covered, let's move into tax minimization and Roth conversions. A key lever in retirement is converting portions of traditional IRA balances to Roth before required minimum distributions begin. By strategically filling lower tax brackets today, you can reduce the size of later RMDs and potentially lower lifetime taxes. This requires careful modeling against income thresholds that affect Medicare IRMAA surcharges and, if applicable, Affordable Care Act subsidies. If you anticipate leaving assets to heirs, consider how the 10-year withdrawal rule for many inherited accounts will change their tax burden. With the concept in place, let's visualize this across time. This timeline splits planning into two phases. From approximately ages 60 to 72, you harvest capital gains in low brackets when possible, perform partial Roth conversions up to a predetermined tax bracket ceiling, monitor healthcare-related thresholds, and rebalance in a tax-efficient manner. Once you reach the required minimum distribution age, currently 73 for many, you incorporate RMD withdrawals, potentially use qualified charitable distributions to satisfy part or all of RMDs if charitably inclined, and continue to preserve Roth assets for the later years or for beneficiaries. Now, to cement asset location, let's test your knowledge with a short quiz. Question: where should high-yield bond funds typically be held to reduce current taxes? Options: A. Taxable brokerage account. B. Tax-deferred accounts such as a traditional IRA or 401(k) Roth IRA. D. In cash under the mattress. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is tax-deferred accounts, such as a traditional IRA or 401(k). Interest from high-yield bond funds is generally taxed at ordinary income rates, so keeping it sheltered can reduce ongoing tax drag. Next, let's refine the withdrawal sequence and see how it plays out across accounts. A practical sequence starts with a cash reserve covering 6 to 12 months of spending. Next, draw from taxable accounts when it is tax efficient, such as realizing long-term gains in favorable brackets. Before required minimum distributions begin, execute partial Roth conversions to manage your current versus future tax burden. Then, when needed, take additional withdrawals from your traditional IRA. Meanwhile, Roth accounts are typically preserved for later years or for legacy purposes, because qualified withdrawals are tax-free. To visualize the interactions over time, let's look at a sequence diagram. This sequence diagram shows a rolling, multi-year rhythm. In year 1, living expenses are withdrawn from the taxable account, and a partial Roth conversion transfers some traditional IRA funds into Roth. In year 2, the pattern continues, with conversions sized to the top of the target marginal bracket after considering all income sources. In year 3, if taxable balances are depleted or markets dictate, traditional IRA withdrawals can cover expenses, while Roth remains mostly intact. Each year, it's important to reassess tax brackets, healthcare thresholds, and market conditions. Now that the sequence is clear, let's move into a practical checklist you can follow. Follow this step-by-step process. First, define your annual spending needs on an after-tax basis. Second, inventory assets across taxable, tax-deferred, Roth, and cash buckets. Third, maintain 6 to 12 months of cash and invest the remainder according to your plan. Fourth, optimize asset location by placing income-heavy assets in tax-deferred accounts and tax-efficient equities in taxable. Fifth, model multi-year taxes under scenarios with and without Roth conversions to identify the best bracket management. Sixth, establish your withdrawal order and a periodic rebalancing schedule. Seventh, monitor required minimum distribution age. Medicare IRMAA thresholds, and any applicable state tax or ACA impacts. 8th, consider a fee-only fiduciary for targeted reviews. 9th, document your approach and revisit annually or after major life events. Next, let's quantify the cost trade-offs between fee models. This table compares illustrative costs. A 1% assets under management fee on a $2 million portfolio is $20,000 in year 1, $100,000 over 5 years, and $200,000 over 10 years if we ignore market growth. In reality, if markets rise, those fees grow in dollar terms. A flat fee planning engagement with modest annual check-ins could total significantly less over the same period. A do-it-yourself approach with occasional hourly consultations can be even lower, though results depend on discipline and expertise. With costs in perspective, let's reinforce tax planning with another brief quiz. Question: which strategy most directly reduces the size of future required minimum distributions? Options: A. Wait until RMDs begin at age 73. B. Hold 20% of the portfolio in cash. C. Perform Roth conversions before RMDs begin. D. Buy annuities without evaluating taxes. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is to perform Roth conversions before required minimum distributions begin. By reducing the pre-tax account balance earlier, you can lower the dollar amount of future RMDs and potentially reduce lifetime taxes. Now, to finish strong, let's summarize the key points from today. The key ideas are as follows. First, you may not need ongoing 1% asset-based fees. Consider fee-only, planning-first advice that matches your needs. Second, asset location and a disciplined withdrawal sequence are major levers for tax efficiency. Third, partial Roth conversions before required minimum distributions can significantly reduce lifetime taxes. Fourth, hold a reasonable cash buffer, but avoid large idle balances that hurt long-term efficiency. Fifth, document your plan, model taxes across multiple years, and review annually to make evidence-based adjustments. And to close, let's provide a concise summary and a call to action. In summary, retirement success relies on shifting from growth to tax-smart income distribution. Beware of paying 1% on assets indefinitely if your real need is targeted planning. Use frameworks, diagrams, and checklists to translate strategy into action. And, as always, consult a fee-only fiduciary and a tax professional before making moves. Finally, let's wrap up. Thank you for watching. If this video helped you think more clearly about retirement income and fees, please like the video, share it with someone who is nearing retirement, and subscribe for future content. We would love to hear your biggest question about retirement income in the comments below. See you next time.